To anybody to hear that you are bullish on the market. I think that's fair to say. You suggest today in a note that you think the odds still favor that markets bottomed on 224. You're standing by that. What do you make of what the Fed chair had to say today and the level of specificity in which he said it?
Well, it was a positive development. I mean, that's why we're seeing markets react the way it is. I mean, a lot of it is what the committee members said, which is visibility's returned. And I think today we did finally price in the first hike. So March 15th now is just a formality. But I think that the second sort of importance of today's testimony is it's an incrementally dovish move because it's acknowledging all the challenges because of this war. And it takes down, I think it reduces the risk that the Fed will tighten into and create a recession. So I think it kind of validates our view that even though the first half is going to be pretty tough here, the 224 might actually be the low for the first half. But again, I'd say the odds are increasing. I'm not sure how much, I don't know what probability I could assign to that.
How many hikes by the Fed are you personally now expecting?
Well, I'm looking more at Fed futures to see what the market's pricing, Scott. And so I think, the 4 to 5 sounds appropriate. But of course, there's a lot to happen. There's a lot of news that'll happen between now and December. So I would say, again, I think the best thing to be said today is that the Fed doesn't look like it's behind the curve. The 25 basis points is what the market was expecting.
But we know that Powell, and he said as much himself, you got to be careful about reading too much dovishness into what he said today, because at the end of the day, though he was specific about 25 versus 50, he didn't give you any indication to think that they were going to change course in the bigger picture, Tom Lee. And that is perhaps the biggest headline that you get today, not the 25. It's the fact that no matter what's happening right now, as of today in the world, it's not enough to move the Fed chair off course.
That's true, Scott. I mean, I think that there's sort of a binary view in markets that if the Fed is normalizing, we should have a bear market. But as you know, normalizing monetary policy that's appropriate, even though it's an adjustment, doesn't mean stocks have to fall into a bear market. So I think that that's a really important distinction. And also by sort of slowing some of the hikes, it is giving us more time to really understand how much of the supply chain is adding to pricing pressures versus unremitting demand or excess demand versus supply chain issues. So I think it's an incrementally positive development.
Steve Leisman, or Tom Lee, you stick with me for a second. Steve Leisman, I know you have to run. I want to ask you one last question, and I want you to react to what Tom Lee had to say, specifically on the idea that by simply mentioning the fact that Ukraine has introduced uncertainty into the outlook, at least somewhat. And even if it's such a small amount, there is that level of uncertainty that he says, does Powell, we're going to proceed carefully. If that in and of itself is a more dovish tilt today than he has been of late.
So for now, my problem, Scott, as a human being, is I really understand both sides. I can incorporate Tom Lee's optimism and Stephen Weiss's pessimism into my brain and understand it all. Because listen, Tom, you have to understand this, that the chairman is saying inflation is going to come down one way or another. So let's examine what that means. One way is we raise modestly and we're able to take our time and do this in a measured way. And we get the help from all the things we talked about, supply chain disruptions, people coming back to work. Or the other means that they step on the gas pedal, or they step on the brakes really hard. They end up raising rates in a very, very hurtful way or painful way for the economy. That possibility does exist. I feel like that's the world that Steve lives in. We don't really know. Nobody has done a very good job, Scott, of predicting where this economy is going and the data during this pandemic. We're coming out of this thing. We haven't done it before. So I would think that there's room for both of you guys to have really good points of view on this, and I could see both sides of it.
Steve, I know you got to run. I appreciate your time with us today. That's Steve Leisman. Right. Tom Lee, the bottom line is no matter what, because of what the Fed is going to do, it's undeniable growth is going to slow as well. They may be able to get inflation under control, but by doing so, they're going to slow down the economy. It's a foregone conclusion. It's going to happen.
That's right, Scott. But I think part of the discussion also is to include about positioning and market expectations and consensus. And talking to our clients over the last couple of weeks, I think many were fearful or almost hysterical about inflation being out of control and the Fed so far behind the curve. So today's testimony is kind of a sanity check, and 25 basis points is an incrementally dovish move. And then from a market's perspective, it's providing visibility. So I think what we're seeing today is really markets were positioned for a much more hawkish Fed and a much more dire outlook.
What seems reasonable to you, before I let you run, let's say the halfway point of the year for the S&P 500 and then for the remainder of the year in total for the S&P? What's a number in your head, or a couple of them, that makes sense for investors to think about today in light of what your own expectations are for this regime of the Fed, which we're expecting is going to remain intact?
Our base case from early December 2021 for this year was that the market would be at best flat, but a drawdown of as much as 10%. So that's been our expectation through June. But I think we see a lot of these headwinds become tailwinds as we get further into tightening, better clarity on inflation, and closer to the midterm cycle. And so we still think you're going to exit the year with S&P 5100 or better. And that means, a second half rally that's double digits. But again, just getting through the first half, that's challenging.
We will see you many times between now and then, I know. Tom Lee, thank you for joining us. That's Tom Lee from Fundstrat, of course.